Good morning. Welcome back to the Retirement Report. I'm Hank Perch, your host. All right, I was talking a little bit about the market this morning. I kind of got off on a lot more in depth there than originally planned, but it's just in reading these articles and reading and keeping up with the news in general with regard to these research papers and what's going on in the market with regard to the bond market in particular, where we're starting to see a bit of a turn here. As well as, when you hear a lot of talk about negative returns, and you've heard even our administration talking about maybe we need to go in that same direction as what's going on over in Europe and the new accommodative policies in Europe going on just this week. This is just more of an indicator of, where is this pushing and where is this leading? And here's the most important part. When you see these things, try to make a little sense of it as far as how it might impact you with regard to your planning, and in particular with your investments. And this is when they're talking about negative yields with regard to government debt. When we're talking about a German 10-year bond that is down about about I think it's a negative 0.5%. When you see those kinds of things, what does that mean with regard to you? You're thinking, well, it doesn't affect us, but it may actually, because when we're looking at pension funds here in the United States, which, of course, some of the bigger investors out there in the pension fund world, what are they buying? Are they buying these things? And the answer is yes, they are. And mutual funds, some of those are buying them as well. Why would they be? What are the strategies? Why would they think that, they want to pay insurance just to get their money back in 10 years? What are the concerns there, and how might that impact you with regard to your investing and your retirement plans? One of the things when I talk about stress testing your investments and taking a closer look inside to see what you have and making sure about your asset allocation model, right, that you've got some defensive strategies built in there to help you in the next downturn, and to make sure that you're able to maintain your income throughout retirement without worry, and that it's going to increase with inflation, that you've got all of that covered with good planning. That's why we do comprehensive planning. We look at the whole picture, not just one facet, not just the investment side, as important as that is. We look at taxes, we look at things like Social Security, we look if you've got a pension, we weigh all the different factors, healthcare costs in retirement. All of these things matter. All of these things, if you've got a plan for them, you reduce the risk of them, and you make, it helps assure that you're going to, in fact, attain your financial goals. One of those being to determine, do you know what your needed rate of return is to accomplish those financial goals? How much do you need to be making on your money, and how can you minimize volatility in hitting that target? And if you don't know these things, they're very important, and they can help you. It can be the difference between running out of money or having plenty of money. As Tony Robbins put it, it might be the difference between being a homeless camper and a happy camper. All right, let's go with the happy camper route. Okay, so when it comes again to the bonds and stuff, and as I've talked about before, there are a lot of risks there in your portfolios. Please take a look. Get with a good advisor that can help you with that. If you don't have someone, give us a call, 615-376-5325. Tess is standing by. She'll get some information from you. She'll send you out a checklist of things to bring to your appointment with me, and we'll help you with this same comprehensive planning I do with all my clients, and get you on a path to financial freedom in retirement. Simply meaning you're going to be able to attain and maintain your standard of living, quality of life, do all the things that you enjoy in life, have fun money factored in there, right? Make the most of those retirement years without fear of running out of money or with having to cut way back and reduce that lifestyle later in life. We'll show you how to do that with good planning, and we'll talk to you about your taxes. We'll talk to you about estate planning. We bring it all together in one place. Okay, now that we've covered a lot there, I want to get back onto our program. We've been talking about of tax planning and how it changes over the 4 stages of retirement. Remember, we talked about pre-retirement, ages 50 to 60. These are your highest earning years, catch-up years to, pump money into your retirement accounts, for instance, is one of the factors there, and as well as increasing other savings and investing. Then your early retirement years, 60 to 70. This is the go-go years, as economist Tom Hegnan calls them, and this is when you've got your first retiring maybe, and you've got the money and the energy and the time to really make the most, start checking off maybe that bucket list. And then we have your normal retirement years, 70 to 80, or later retirement years, we'll call them even. And these we call the slow go years. This is when maybe you're starting to, in the early stages, you're still go, 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 and then you start slowing down a bit as you maybe get into your late 70s and on up to 80. And then after age 80, we call that the late years and the no-go year, where we typically nest more, right? So when it comes to your own retirement, okay, and what you want it to be, these are some of the factors that are, that you may want to consider. All right, so we have an alternative approach. We talked before about the traditional approach when it comes to taking income from your accounts in retirement, being that you would use all your taxable dollars first, then your tax deferred dollars, then your tax free dollars. So in other words, taxable dollars, money you've already paid tax on, but each year these may be invested in the stock market, it could be money just sitting in the bank, but each year you're paying tax on the interest and dividends it earns. Your tax deferred, of course, are your IRAs, 401ks, maybe annuities, 403bs, your TSP, thrift savings plan, all these types of retirement accounts, SEP IRAs, those are tax deferred. So that money is growing tax deferred. You just keep putting money in there. You haven't paid tax on any of that money, and when you take it out, you'll be paying the tax at that time. And then your tax-free dollars, which would be, for instance, Roth IRAs. And those are monies that you have paid tax on, but the money is now growing, the earnings on it grow tax deferred, and when you take that money out, both the principal and the earnings are tax free. So the traditional approach was we'll use up the taxable dollars because we want to defer as long as we can. Then we use up the tax deferred dollars, and we want to leave the tax free to grow as much as it can, and that's the last bucket of money that we would go into. However, there's an alternative approach, new academic research showing us that that's not always the best way to go. As far as spending that taxable money first, but what about also converting, and here again, I'm going to, beyond the studies, what I see also in my practice is how you would, your individual situation dictating sometimes where it's not just a take from this bucket, then this bucket, then this bucket, but maybe it's a little bit from each to help us maintain a particular tax bracket, while, in other words, we can have a higher income than we need to pay, than might be taxable income. And that's how we blend these together to accomplish that goal. And that goal being, of course, we want to minimize taxes over our lifetime, not just for 1 year. And Roth conversions are an area, and I talk a lot about those. It's probably one of the best things ever come out of Washington, but not for everyone. It's your individual situation, though, might dictate they're not, it may not be a good plan for you. It just depends on your tax brackets and a number of other factors that are going to come into play. And so when it comes to a spending plan, an alternative approach would be that we look at that, and if you are one, and I'd say that a lot of people are, right? We do a lot of Roth conversion strategies with clients. And what we look there is on your situation, if we're going to be able to save you taxes over the long term by doing some conversions in the early years, especially when we're in this very low tax environment, then we want to take advantage of that. And we've only got about 5 years before we see the sunset provision in 2025 will kick us back up to what the taxes were prior to this tax cut. All right, and so we want to take advantage of that, and this is a good time to do it. All right, so consider Roth IRA conversions, and understanding that in this example I'm going to use, if you look at an IRA or similar retirement funds, 401k, 403b, TSP as we mentioned, and you move those to a Roth, the taxable amount is converted and it's added. Now, whatever you're converting is added to your income. So if you converted $100,000 from your IRA to your, or 401k, whichever, to your Roth, then you're going to have $100,000 added in taxable income that year. Now, that's not normally, we don't always do those large conversions. Again, it depends on your situation as to whether that would make sense and what tax bracket you're in now and what tax bracket you may be in the future is one of those. And another factor that comes into well, first is understanding that, and we, of course, so we're looking at how's this going to affect us. If we take advantage of being in a low tax bracket today, and we're using $100,000 in this example, but that could be anywhere from, you can convert any amount. Okay, it could be higher than that, it could be lower than that. You can stretch it out. If you were doing a conversion of 100 was the goal, but maybe we'd only do 20 or 30,000 a year to get that accomplished if it would keep you in the lower bracket and thus save you taxes long term as well. So one of the ways to do that, we're going to call a strategy, is filling up the bracket. So a Roth IRA conversion strategy says I'm in a particular tax bracket and I've got room between what I earn and the upper end of that bracket. In other words, let's say I'm in a 12% bracket, married couple age 65. I think it's about 104, 105,000 for this year is your cap. That means your AGI, your adjusted gross income, needs to stay under that 104, 105 to stay in the 12% bracket. Well, let's say if your taxable income, your adjusted gross income, is 80,000. We'll go ahead to the next slide, Marilena. If you're in that 12% bracket and you're able to, let's say, have that $20,000 or $30,000 room to do some conversions. In other words, we're going to say, well, your taxable income is only 75,000. The cap is 105. I've got 30,000 I can convert to a Roth in that scenario and still only pay 12% tax. I've now filled up that bracket. Now you can see in the example we're talking about the 22% bracket in the same concept. How much do I have there? I could add another 65. In this example of 100,000, I could maybe add another 65,000 of taxable income and still be in that 22% bracket. So filling the bracket strategy simply means I'm going to maximize the bracket I'm in with these Roth conversions, so I'm not going to pay any more tax on it and yet avoid going into a higher bracket. Now this can be a real important strategy when it comes to required minimum distributions and how they will affect what bracket you may be in as well. All right, and I'll explain that after this break. But first, we'll take a quick break. Join me here. We'll be right back on the Retirement Report.